Alrighty, so we are on stock selection, scanning, and watch lists. We are past video number 5, so the rest of the series, so 6 through 10, is going to be where we really get into a more process-oriented and very focused, sort of an actionable like stage in the series. So everything up till now has been very context-based and just sort of getting your general understanding and footing in the market, and then now we understand enough and we understand sort of the basics of what's happening, and now we can get into the actual execution and really the bulk of the learning that's going to happen in here. So we're going to jump right into stock selection. There's a couple different types of stocks in general. I would say that as far as good stocks go, there's two types, and then as far as bad stock go, there's two types. So for good stocks, you're going to have market leaders, which are going to be these really consistent move up gainers. These are going to be the stocks that have big earnings, big sales, consistent earnings per share gain. They have global products. They have really innovative technology, and they're going to be these leading stocks that are in leading groups. And these are sort of what move the market to the upside. And then likewise, you have high ADR momentum leaders. So these are going to be the really, really quick moving stocks, and these are a little bit different. These are going to be very volatile, very high ADR. They're going to be high liquidity and high dollar volume. They're going to be controversial or a trending stock. So like you'll see up in here, two of these are quantum stocks. So you're going to have people that are really talking about quantum. They're really going to be become a buzzword for a little bit, and these are going to trade crazy to the upside. They're going to move up thousands of percents very, very quickly. So these can be good to catch, but they are going to move in a very different way than a market leader would. So bad stocks are going to be market laggers, which are just going to be stocks that trade down constantly. These don't really ever have any buying opportunities, and you're going to need to see a really big news catalyst or a really big change of character to feel like this sustained move down is over with. You know what I mean? And then the other type of stock are going to be untradable action. So sometimes you'll have a stock that is very well leading, but it's going to have really bad action. So like if you see down in here, you can see like how choppy these charts are, and there's not really going to be clean points of entry or clean ways to manage these charts. It's just so up and down and sporadic, and you can't predict anything. And you're not going to see clear basing patterns, and it's just sort of a mess. And these are going to be untradable. You cannot trade on these. It's just not like you will lose money. There's no point in getting into something in here thinking you're going to catch a breakout just for it to gap up, immediately shoot down, gap up, immediately shoot down. You know what I mean? So what as a whole makes a winning stock? This point comes from a Jack Corsellis video where he's talking about Mark Maravini and sort of his stock selection process. But he sort of coined the idea of the 95% club. So these are characteristics of the biggest winning stocks. This has 99% of biggest winning stocks are going to be above their 200-day moving average. 96 are above their 50-day moving average. 95 have a small float. 95 show earnings acceleration, and sort of so on and so forth. But these are going to be an outline of what the top characteristics of these do. And so 98% of these big winning stocks made the largest portion of their gain or the fastest portion of their gain in a stage 2 uptrend. So this is where we tie back into a couple earlier videos where we talk about like the price cycle. So we're talking more, we're getting into that price cycle, that Wyckoff mentality where you're really trying to capitalize on these stage 2 uptrends of this. So what is our stock universe going to look like? The U.S. markets have about 5,000 stocks, and we really need to nail down and figure out what we're focusing on to increase our chances of getting ourselves in the right stocks. So first of all, we're going to have trading. We want trading to be above its 50 and 200-day moving average. That's non-negotiable. We want 500-day. We want 500K average volume traded daily. Anything under that gets sort of illiquid. We want price to be above $3. This is a little bit more negotiable. Fidelity labels any stock under $3 as a penny stock, and you get additional fees on it. So this is sort of a little bit more for me. If you wanted to make this like $1, go for it. But we'll talk about more specifics and why these are why they are. And then ADR above 2%. So for trading above 50 and 200-day moving average, I want a long-term positive uptrend. I've never seen a point in trading a really quick pop in a stock that is in the context of a super long, like multi-month or multi-year long downtrend, unless the ADR is like 30% or something like that, where it's like I know I only need one day. So in general, the only stocks that I'm looking to really swing trade are going to be stocks where where it's in a long-term uptrend. You sort of have the wind behind you. And then for 500 average volume traded daily, liquidity and perceived value above all else are what institutions and large investors really need to build large positions. Anything lower than 100,000 to 500,000 are going to trade really thin, and it's going to be hard to manage. So if you went down on the 5-minute chart on a stock that traded only like 550K, the candles are going to be like super thin candles, and they're going to gap up and gap down. It's going to be a mess. It's just not sort of what you want in terms of liquidity. And then you want price to be above $3. I already said more about Fidelity, but stocks under $1 are more likely to be stocks that didn't start at $1. They're just already stocks that people have lost a lot of money in. So when they start to trend upward, they're going to be met with a lot of selling as people try and break even on their old positions or try and make back a little bit of profit that they could have missed out on. And then so ADR above 2%. If SPY's average daily range is around 1%, I want the individual stocks that I'm picking to be at least double. If I'm going to take on more risk by picking individual stocks, there has to be a way to offset that risk by having more gain. Otherwise, just leave your money in an ETF. So, as far as scanning goes, this is sort of where we get a little bit more detail oriented into this. I really only use two scanners. I have a wide and a narrow scanner. So, the US market, like I said, has about 5,000 stocks. With my wide scanner, I'm trying to narrow that down to about a couple hundred, so 200 to 500 stocks. And then with my narrow scanner, I'm looking to narrow that down to 50 to 100. And you can see the criteria here. So it's just what we talked about with our universe, right? So price above $3, ADR above 3%, and you can adjust this if you're getting lower, like too many or too low results. So price above its 50-day moving average, price above its 200-day moving average, and then average volume 30 days is going to be 500K. So that's wide. So that's really all of the stocks within our universe are going to fall under this wide net here. So when I'm adding stuff to watch lists, this is really where I'm going for that. And then if I'm looking to sort of identify what are the strongest within that wide list, this is where narrow is going to come into play. So once again, price above $3, price ADR above 5%. So we're looking for stuff that moves quicker. Price above 50, price above 200, and then price, this is going to be dollar volume. So TradingView uses a little bit of a different, it calls it turnover for whatever reason, but this is just the number, like the dollar volume for shares. So that would be like if a $5 stock traded 100 shares, it would be a $500 volume, you know what I mean? So I want that to be over 100 million. Those are so going to be the most liquid stocks, the ones that institutions are able to sort of pile in big shares to and big position sizes into, and that's really what I'm looking for. And then both of these are sorted by market cap. So selection and assessing character. There's a couple things that I'm looking for specifically. I truly think that stock selection is the most important factor for swing trading, and it's the hardest. I actually took a little bit of I took a break from making the videos in the series, and I took a couple days off because I got to this section of the series, and I was really struggling with. It felt a little disingenuous to talk about this because I was really struggling with this towards the beginning of making the series, and I was having sort of a bad month. And I sort of wrapped it up pretty well on the month. I broke just about even, considering the fact that I was down like 8% on the month. But I was really struggling with stock selection at a point, and it felt disingenuous to talk about it. So I took some time off to really figure out and narrow down what was working and what wasn't. So in terms of my own trading, selection is really where I struggle the most, and I think a lot of the time it's due to information overload. There's so many things that you could be looking at, and there's so many things where it's like this signal could be positive, but it could also be negative, and then there's just so much. So you really need to ask, like, how are you going to rank the stocks that you're watching, and what makes setups more desirable than others? So the biggest thing and the number one sort of golden thing here is going to be relative strength and group action, and we'll talk about this, but we'll get really specific into this. And then you have, I truly think that long-term relative strength and day-to-day relative strength and group action are the key to sort of selecting stocks as a whole. You could basically do it entirely off of this, but then there's a couple other things. So the reason for this is that what may look like constructive basing for a stock could actually just be the start of a breakdown or a deterioration in strength if that sector or that group has been on an absolute tear and still is on an absolute tear, but that individual stock is sort of faulting. So you really need to be aware of sort of its peers and what's happening in that general corner of the market. And then you want to look for constructive basing. So that's going to be a visible history of identifiable basing patterns like we talked about in the last video, or just trading characteristics. This is going to be really important. You need stocks that are cyclical. So stocks as a whole are cyclical in nature, and the best move is a way that's predictable and understandable. You need a stock to move how you think it should move. So you're looking for that repeated movement. So the best stocks are going to have very clear moving averages that they bounce on, they consolidate, and they trend around. And without this repeatable behavior, you can't anticipate what's going to happen next. There's a reason that the best stock traders are just the best at sort of anticipating what's happening next and then reacting to it. You have to have that sort of gut feeling, and that gut feeling comes from trading stocks that have repeatable behavior that you can look back on and see how a stock moved in the past in a similar context and really base your decisions off of that. So a bonus to this is going to be strong fundamentals. I'll super briefly go over that. It's not very important, and I think you can keep it fairly simple and sort of understand the point of it. So we're going to look at a couple charts here. We're talking about constructive bases. So do we see typical continuation bases in this chart? And I'm going to point to some of them, we're going to label them, but as a whole, what do you see when you look at this chart? Because when I see this chart, I see a couple things. And when we're looking for these breakouts, you're also going to need to look at the kind of follow through for these. You don't want a stock that breaks out and immediately shoots back down into the range. That's sort of going to be deconstructive. You don't want to trade stocks that have that, or if you are going to trade stocks that have that, you need to be acutely aware of that, and you need to figure out a different way to entry than a breakout. But as far as continuation bases go, what I'm seeing on this chart, I see a little cup and handle in here where price sort of sells off and we pick it back up, make a little handle in here, move higher. I see a big cup and handle, so buying, selling down into a range, sort of undercutting here, buying up, resistance at that high, another buy up. I see a wedge, so lower highs, higher lows, breakout. I see a Darvis box, flat and flat, a breakout to the upside. So this is a stock that's going to that is showcasing and displaying very constructive and showing all types of continuation bases, which is a really healthy sign to see. And then as far as the follow through on these breakouts go, it's all very positive. So when we break out of this cup and handle here, it's very positive when we trend up for at least a couple days before consolidating back down. And then same thing when we break out of this cup and handle. So we got like 2-3 days up in here that are really positive. We base again. There's not really a fear in this basing. It's very constructive. Move up. Same thing. We got really good trending up in here and really good follow through on these breakouts. So when we're looking for repeated movement, we're looking for areas where price has come back to, sort of where that stock is magneting back to. So where do we consolidate? Where do we bounce? And where do we trend along moving averages? So what I see in here, I see that we consolidate typically around our 10 and 21 day moving average, and you can see that back in here as well, and back in here. Back in here is a little bit lower, but it's still the same era of thing. So 10 and 21 day moving average consolidation. I see 10 EMA bounces, so we'll bounce really closely to that 10 EMA, bounce off of it, we bounce in here, and then we move higher, and then we have a 21 EMA shakeout. So when price is really trying to shake out and really undercut lows, you can see that we've really effectively bounced off of this 21-day moving average. At one point in the day, this stock looked horrendous. It looked like it was completely falling back down, but we really picked it back up as buying picked up, and we made a huge move up afterward. So this is all really, really constructive behavior, and you will need to be aware of this in terms of when you're assessing a stock's character. So as far as trending goes, we need to talk about sort of time value. So let's say that we bought in here off of this consolidation period in here, and we were looking to sell this. You need to think about what moving average is going to be the most effective to trend your stop with. So if we trended this stock, right? If we trended this up and we said that we were going to use the 10 EMA as our trailing stop, we want to sell the stock as soon as it closes under that 10 EMA. We're going to trend this up, trend this up, trend this up, trend this up. We stop out here. And then if we wanted to trend this with the 21-day moving average, you would trend this up, 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 trend this up. You would stop out here. So you need to be looking at the time value and what's the most effective for this. So for the first close under the 10-day moving average, we get a 73.15% gain in 50 days. And then so that's a 1.46% a day time value. And then as far as the first close under the 21-day moving average goes, we get a 313% gain in 124 days. So that's a 2.53% time value. But we also had earnings in here, which if negative could have really fucked us over here. So you need to think about what is valuable for you, and you need to think about, do you want to sit in a stock that is potentially going to consolidate for this long, or do you want to just book that quicker profit and have a slightly lower time value and just sell out here so that we can, and you may potentially miss a move up to the upside, but you got out really quickly and you could always re-add if you really wanted to. You need to be thinking about that and you need to be aware of that. And some stocks really like to bounce on their 21-day moving average, so you might want to trail the 50. It really all depends on that. If you wanted to trail the 50 in here, you would be giving back a lot of profit on this upside here. So you really just need to think about how you're going to assess the stock's character and how you're going to trade it when you're in it. So what does long-term relative strength look like, right? So I'm going to highlight a couple areas on the chart here and just I'm really going to draw some key points to the differences in this. So this is SPY here, and then this is SMR, nuclear stock. So this point number one here, this is going to be SPY. So as SPY gaps down and touches down on this this moving average in here, so hold on, wait, I think I can actually highlight these individually. Yeah. So I have 4 key areas that I'm sort of looking at here, and we're going to go over them one by one. So for number one, so this area here, SPY touches its 50-day moving average twice. It gaps down. So first of all, it gaps down and then pushes down aggressively, and then we try and pull up, we touch it again, and then we move up and gap up higher and continue trend up. But this was a really bad time in SPY, and during this time period for SMR, we never even touched below the 21 EMA. We gap down and we sort of wick this 21 EMA very lightly, and then we continue to trend up. So that's already displaying incredible relative strength to the general markets because we don't have an incredible deterioration in price while SPY is really struggling in this low area down here. So in this time, SMR barely touches 21 moving average. Number two, I really want to draw a point about how quickly SPY sort of sliced through its 200-day moving average. In general, this never happens. This is not something that's going to be commonplace. But so while SPY is slicing through this 200-day moving average here, SMR gets to its 200 and it sort of holds it in here and bounces off of it. So these are key things that you need to be privy to so that when the stock sets up, you already know that the stock is strong. You don't have to go back through and assess this character like right as you're about to make a trade. And then number three, so as SPY, so if we look at this here, these March lows, I want to draw a point as to how intensely SPY sort of undercuts these lows and then reclaims it, while SMR just barely undercuts it down in here and then reclaims it almost immediately to move up higher. So, and then for number four, we can see how SPY really aggressively trades up and sells off and has this gap down here to its 21 and 200 and then go up. But during this time, SMR just sort of hovers right here and touches its 10-day moving average before a huge move up. I believe it went up like 250% during this time or something like that. But so these are the things that you need to be aware of because this in here definitely could have been categorized as a Darvis box and you definitely could have been targeting that through the high in here. And knowing that the indexes were trading down up in here and likely to bounce in here is sort of a key indicator in terms of, is this stock displaying relative strength really closely to the basing? Is the stock displaying long-term relative strength? You have to be aware of these things as you're about to trade a stock. So what does short-term relative strength look like? These are on the daily chart. This is SPY over here, and this is RKLB. This is a defense agency stock. And we're going to go over, once again, a couple key points on the chart here. So during this time period in here, these are just sort of some micro sessions, but you can see that both of these stocks appear to be basing, right? So SPY is sort of making these basing patterns, is building these higher, or these higher lows, these lower highs. It looks like it's contracting to either the upside or the downside. And during this time, it's had some pretty bad sessions, right? So SPY's last 3 to 6 sessions have trended down, and the most recent candle actually closes under its 10-day moving average, while our Rocket Lab is showing clear general strength compared to the market just due to how these last 3 candles have been. So for these last 3 candles, SPY has had a really weak close here, a bad red candle, and a contraction red candle up in here to close under its 10-day moving average, while Rocket Lab has had a really strong move up here, a fairly strong close up in here given that the general market was down that day, and then a really strong push to the upside given that SPY basically did nothing that day. So if I'm looking at this, right, and I think that SPY may bounce off of this level or bounce off of its 21-day moving average, I could be looking to target this through the high of here. And so let's look at the next session of this, and we'll look at sort of what both of these, what SPY did and what Rocket Lab did, and you can sort of see that intraday relative strength and what would give you the confidence to hop into a trade for this. So these are going to be this is the 5-minute chart for the session after the chart that you just saw. So during this, you can see that the opening candle for SPY is very indecisive, right? So we are right on that 10-day moving average, and we sort of trend up just above it a little bit. We have low buying volume, and then we flush down to the downside. We get a little bit of a pickup here, flush down, wick off of our 21-day, buy up, end up right under that, or right above that 21-day moving average. While Rocket Lab, we open and we have sort of a negative reaction initially, but this sort of just sets our low. We have low selling volume up in here, and then we immediately buy it up to the upside. We're up in here, we sort of ride this trend up as SPY is flushing down in here and making these new low of days and then bouncing off of its 21-day. You can see that Rocket Lab never even gets close to its low of day, even during this heavy market pressure intraday. It really stays up in here, and we end up having a really strong close into the end of the day there. And then so as far as group action goes, I really only have 2 slides on this. It's not like it's a little bit hard to talk about group action. You just you just need to sort of bear with me on this. Excuse me. So these are all going to be defense stocks, and oops, I actually had Rocket Lab in here twice. But these are all defense stocks, and you need to think about this from a group perspective, right? So the market in general is actually very thematic in nature. You need to think that institutions and algorithms are really going to be piling in on stocks and sectors and industries that are displaying relative strength or just had news come out, or they believe that for whatever reason this industry or this corner of the market is going to be very successful coming up. So if you were looking at this, right, where you're looking at all of these stocks in the same group, these are all defense stocks, and you're looking at a vaguely similar setup. So we have all sort of made these move up, an aggressive move down, and then we've sold up, and we're sort of consolidating and basing up in here, maybe potentially building a large cup and handle or a short-term cup and handle up in here. And you can see that across the stocks. You can see that across the group, and you can sort of identify which ones are the strongest and which ones are the weakest. But in general, these are going to trend together. So when you see something like this, where every stock in the group starts to gap up, this can really help you identify where the relative strength is in the market, and it can really help you give confirmation so that you're not just seeing a gap up and being like, is this going to sustain? Is this not going to sustain? If the whole group is doing it, it's probably very correlated, and it's probably something very significant that you could pay attention to. So that's group action. I'll give a basic overview of fundamentals. It's not like super. I truly think that fundamentals are something that gets really lost in the weeds and sort of like very convoluted when it doesn't necessarily need to be. So we're gonna look at SoFi. This is on the TradingView Financials page, and you can look at this whenever you want for any stock, but I think it can be really helpful. But so if you go to the overview tab, you can see the performance and the revenue, net income, and net margin. So ideally what you want to see as a whole, you're only looking for these upward slopes, right? Like this is like when you're assessing a stock's fundamentals, you're just looking to see that they are growing every year. You don't want to see something that's like in 2021 they were up here crazy and then in 2022 they really like fucked up. Like that's not exactly what you want to see in terms of trading like those market leaders, the ones that are just going to have those consistent earnings beats, the consistent trending up. That's not exactly what you want to see. So you're trying to look for sloping up in here on the annual. You're looking for steady quarterly gains, and that's really what you're looking for in terms of revenue and net income, net margin. Estimates, you're looking for consistent estimates beats, and you're looking for the estimates of analysts to rise for quarters. Earnings, same thing. You're looking for, like, this is a huge blowout earnings. And then same things for revenue. You're looking for the exact same stuff. So trending up, earnings beats, increase in estimates, blah, blah, blah. That's really the creme de la creme. That's what you're looking for across the board in terms of identifying good company fundamentals. I think you could do a whole lot of analysis on this, but as a whole, these are really, really what you're just focusing on. So watch lists. I use a combination of watch lists. And we'll go over what each of these are and what their purpose is. But watch lists, I think that there's a way and sort of a optimal way to go about using your watch lists, right? So I have three. I have my market, I have my groups, and I have my main. So market overview. These are just going to have general indexes. So that's going to be your SPY, your QQQ, your IXIC, your NASDAQ comp. This is really just going to be to quickly pull up the largest indexes, just very, 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 very shorthand. And then you have I hold, and I think that everybody should have equal weight indexes. So that's going to be the SPY. So like S&P 500 is weighted by market cap. If you took away the weighted by market cap and just had everything equal, that's what an equal weight index is, and that can be really helpful to sort of remove that skewing effect that a market cap weighted ETF can have. So I have an equal weight for SPY and an equal weight for QQQ here. I have breadth indicators, so this can be helpful to just sort of view the health of the market and sort of the pace that we're on just at a glance by looking at the percentages in here. I have sector and group ETFs, so this is just sort of helpful to identify the strongest groups. If I see a sector if I see a sector ETF that's just like been on an absolute tear this week, it's going to be something that I put a little bit more weight onto and really focus onto and sort of figure out what's happening there. But it can also just be helpful to see, like right when the session starts, what sectors are really popping up in the very beginning of the day and showing a lot of relative strength to see sort of where that money is piling into. And then for groups, this is going to be my group slash core. This is where all of my leading stocks are going to go. So every stock that I've identified as strong or potential candidate via my screening process or past trades is going to go into this watch list here. And this is going to be sorted into groups. I think there's a couple best ways that you can sort it. I believe that the best three are going to be sorted by sectors, sorted by industries, and sorted by groups. That's what I've done here. It can really help you identify group strength and sort of consolidate where your focus could be. But you could also sort this by market cap, by ADR, really whatever you wanted. But I do think that having your watch list sorted is incredibly important. It also helps you find stocks quicker. My main, I use this for open positions, so this is just to help me quickly view and check on my positions that are open. And then I have my focus, which is going to be stocks that I've selected for the next session that I really want to focus. So this is actually my current watch list for the next upcoming session on this Friday. These are the stocks that I'm looking to see. So if these stocks are displaying really well or really good strength and really constructive behavior, I will probably take an entry on those. And then I also have high ADR percent gainers. So these are just the quickest moving stocks in the market that I'm trying to keep an eye on. Like I feel like I've missed a move on Newegg like a million times. It was up, like it just keeps going up like 40-50% in a day. So I keep an eye on some of the high ADR gainers in case I want to just like throw a couple $100 into like Newegg or something like that and see if I can catch one of those 50% moves. It's basically gambling, but it's something that I keep an eye on in case I really wanted to do that. But that's really it in terms of stock selection and watch lists. I know that I sort of threw a lot at you, but I will get more in depth about some of the topics in this. But I think that something to really take away from this is just that relative strength and that group action that can't be undermined. That's so, so, so important. And when we talk about entries and criteria for and like ranking everything. Well, like we're gonna get more into the weeds about it, but you like that's gonna be the really just the main focus. Everything is gonna come from relative strength and group action, and then sort of the watch lists and everything is just sort of an optimization of that, so that I can manage that with one screen and doing it on my phone. Blah blah blah. So that's really where that comes from. But I appreciate it. I hope that you guys enjoyed this video. I don't actually know what the next topic is. I haven't finished the slideshow for it, but I hope that you guys enjoyed this one. It was sort of a long one, but I appreciate it.